Hi folks, Dan Bird here on Wednesday doing a midweek update, Wednesday, September 4th. I'm going to do this pretty quick, so jump right into it. September started off as they often do with lots of selling. And I've talked about the historical seasonality of September in the past, that it's the worst month of the year. There are some catalysts that might actually help it to improve, which we'll take a look at. But that's how it started. Starting yesterday, the market sold off again today. Dow actually ended up positive. But let's go ahead and jump in, share my screen. First, let's get us ready here. Okay, so for those that are interested, this is my website, breakpointtrading.net. A lot of the content I'll be showing from here. There's a ticker down here, and most of the Magnificent Seven, you can see as they are ticking by, they're mostly, Meta was up a little bit. Tesla actually had a good day today. Tesla was up 4%. We'll look at those in a second. If you would like the newsletter, it's free. Just click right here and you can get the newsletter. Or if you want to be reminded the newsletter is available, you can go to the bottom of the page on the home screen. And the $0 subscription will register your email. We don't share emails, so you should never get spam as a result of coming to the site. If you want to give it a try, there's a 7-day free trial with the $15 a month monthly plan. Doesn't include everything, but it includes quite a bit. And then for $99 a year, you get all the content that's on here. So let's jump in and take a look. First, we'll look at these charts right here, the S&P 500. You can see couldn't get through this previous high. It actually made a lower high, barely, but it did make a lower high. Let me turn my little handy. There we go. So lower high right there. This was the previous high, which it went through. Came back right to the 50-day moving average today and right to the 23.6% Fibonacci level. So, but not with a good candle. So we'll see if it breaks through that. If it does, we're probably going to go down to 5,400 at least, and we could actually go all the way down here to the 200-day moving average. And if we did, that would put it in a lower low, which would be the definition of a downtrend. Now the MACD up here is still defined as an uptrend because it's above zero, but it is crossing over. So we'll watch that for a while. Friday is going to be a big number, and we'll talk about the jobs number here in a second. If we look at the NASDAQ actually definitely made a lower high. Couldn't even get back close to where the previous high was. Filled this gap right here. Went down to the previous resist or support, which was right where it's at right now. And if it continues lower, probably we'll go to the 200-day moving average at about 18,100, right down there. And again, the MACD is not below zero, but it is crossing over. So we may very likely, at least for tomorrow, have another sell-off. There's a little gap right there that might be support. So we'll see what happens. And then Friday will be an important number. The Dow actually looks pretty good. The Dow actually went up. It's trading within this channel right here. So it went up and hit the top of the channel, got rejected. Now is right at the 21-day, which is a reversion to the mean. And it may bounce there, may bounce at the 50-day, but the bottom of the channel is down here at 39,000. So right now we're right at 41,000. So we'll see if that can hold. And again, the MACD is still in an uptrend. So all of these are still in an uptrend, but they are looking dangerously suspect right now. Bitcoin also is coming down. It put in actually four lower highs, really five if you want to count that one. And then it put in an even lower high down here, which means the downtrend is accelerating. So if we put that line in right there. So downtrend now is actually accelerating to the downside. So we'll see if that continues. But Bitcoin's not looking too great. Right now it's below all of its moving averages, including the 200-day, which is not a good sign. And the MACD on this one actually confirmed a downtrend way back here in August, and back here in June, and back here in April, and really has just been on a steady lower high trajectory. So Bitcoin is actually probably looking the worst of all. All right, so let's take a look. First, I want to look at the yield curve. Something that I meant to mention on Sunday, but forgot to. So I sent a notice out to all subscribers, not just the annual and the monthly, but everybody about this, because I really meant to show it. So inverted yield curve, as you can see right now, we are right at the 0 point. So it is really pending going back up, uninverting, going back above 0. And I thought it might happen today, but it didn't. However, if we go back here to the market bias matrix, and by the way, this is a matrix of the indexes, the sectors, the industry groups, the intermarket relationships or relative charts, commodities, metals, and currencies. And the biggest thing I want to point out, and if anyone that is a subscriber, if you do nothing else but just look at this once a day, you'll get a really good sense of what the market's doing. So you can see we've been selling off since back here in July, went all the way down here till the beginning of August, then bounced, came back up, and there also is a lower high. And just in the last couple of weeks, really the last few days, it's been declining pretty rapidly now. And the orange line down here is the short term. The gray line is the medium term, and the yellow line is the long term. The long term has a slow downtrend, but the short term, which usually moves first, is really accelerating now to the downside. And you can sort of see it over here in this colored chart. Get the short term, medium term, long term, and then the overall percentage, which is what this top one represents. But you can see how the colors change. Back here in July, beginning of August, it was all red, started to turn green, except for the long term. And now it's starting to turn red again. So anytime any of these are highlighted like this, means they just changed today. So this gets updated every day. So if there's anything in particular that you're watching, like I just had a subscriber ask me to add silver miners. I had silver in here, but they asked me to add silver miners. Both of those right now are bearish configurations, but I added the silver miners here because you can click on these and see the chart. So you can see silver miners is definitely rolling over. But the biggest thing is that yield curve. So that may be a catalyst. And if we look at the yield curve here, right down here, the 10 and the 2 inversion, and below that is the 10-year and the 3-month inversion. You can see the 10 and the 2 has been bullish right here, which means it's moving towards 0. But if we look at the chart, look at that. Right back here, beginning of August, it opened above 0, uninverted, but it closed below 0. Same thing happened today. It opened above 0 and closed below 0. And it keeps trying to test that 0 level. So it's continually testing that. And at some point, it's going to break through, and it could be any day now. And I'm expecting to hear things on the media that the inverted yield curve is no longer inverted. You can see back here on the charts page that it's been inverted for a little more than 2 years. So right here, all the way back here in July of 2022 is when it first inverted briefly right there. So this is a weekly chart. So for 1 week right here, it inverted and then it inverted. Good right there. So more than 2 years, it's been inverted. So any day now, this is going to uninvert. It's one of my recession watch components. the yield curve, if we look at it on the 20-year, you can see that every time it uninverts, 6 months later, there's a recession. Uninverts here, we had a recession. And we're getting ready to uninvert right here. So 6 more months, will there be a recession? I don't know. There has been in the past. So history says there probably will be. The other ones to watch, and we'll talk about unemployment next because this is coming up on Friday. It's the first catalyst for September that might actually help the market. So this is the unemployment claims. So the number of people that are filing for unemployment. And you can see that most of the beginning of this year, it has been slowly moving up, meaning more and more people are filing for unemployment. And that kind of makes sense when the unemployment rate is starting to accelerate too. You can see 4 months in a row, the unemployment rate has been creeping up. And down here is the Fed rate. So you can see how long the Fed has kept rates high, 5.33% actually, ever since July of 23. So more than a year, rates have been high. The unemployment rate now is starting to tick higher, which is not what the Fed wants to see, but as long as inflation is under control, they will then pivot their focus from inflation to jobs, and that's why they most likely will cut in September. But that is the third catalyst. Actually, let's call it the fourth catalyst. The first one is the uninverted yield curve. That might have some positive effects. The second one is the unemployment claims, which is coming down. So the last 4 weeks, unemployment claims have been lower. And what that should do is cause the unemployment rate to probably tick down this month. Now, last month it was 4.3. The last forecast I looked at was forecasting 4.2, and I think that probably is what will happen. Because the claims have been coming down, I expect the unemployment rate to come down slightly as well. So the market might like that when that happens on Friday. But you can see that the rate of change has been accelerating lately. And if it comes down to 4.2, that's actually exactly where the SOM rule is for September, 4.2. I'm expecting it to be 4.2, could actually be 4.1, but I definitely think it will come down slightly. So that's catalyst number 2 for the market. Catalyst number 3 is CPI, which is coming on, I believe, September 14th. So that'll be the week after. So here's CPI. This is the blue box right here is the 12-month base effect. And the base effect, essentially what that means is whatever percentage CPI is added in September over here, the one from 12 months previous will drop off. That's this one right here. And when a big one drops off, like a reasonably big one here, but there's actually an even bigger one dropping in September, but this one dropped in August. And the CPI went from 3 to 2.9. We actually had deflation over here, just for 1 month though. You can see right there, we had deflation briefly for 1 month. This is the 1 month rate of change. And then core CPI has been steadily declining as well. So what the third potential catalyst, first we have the uninverted yield curve, then we have the unemployment rate ticking down, and then we have a better CPI number. I haven't seen a forecast for it yet, but I would not be surprised to see it at 2.7. And look at the one that drops off in October, just before the election, coincidentally. That one has a big one dropping as well. So I think that one could very likely be 2.5 in October. So catalyst number 3 will be the CPI in the middle of September. And that'll be lower, maybe much lower. That will be positive. The market, I think, will like that because it pretty much confirms that the Fed's going to cut. And then the last one is the Fed rate cut, which I'm pretty sure that they will cut by a 1/4 point. In fact, if they cut by a half a point, the market may not like that. It may sell off if they go to a half. But I think it's going to be a quarter. So as you can see, after the first rate cut, we usually get a recession as well. So that's another one of the recession watch components. But the market usually likes it right after that first rate cut. So you can see right here, market rallied. This one, it didn't. It actually continued to sell off. This was in 2001 when the dot-com bubble was in the process of bursting right there. And actually, it was the beginning of a secular bear market as well. So we usually get a recession after that first rate cut, but the first cut itself, the market will usually like that. So the market could rally on that one. So that's the next catalyst. So even though September is typically a down month, historically, of the last 10 years, two out of the three of the last 10 years has been down, and in some cases significantly down, not rallying until the middle of October. So the only thing but remember, 1 out of 3 of those was up. So that doesn't mean every year it's down in September. It certainly is starting off that way, no question. And it's looking like that might continue, but we'll see if some of these catalysts, first one to start on Friday, maybe the uninverted yield curve might be tomorrow, but the unemployment rate Friday is something to definitely keep an eye on. All right, the last thing is a couple of folks asked me about actually one person I think asked me about 2 stocks. So I'm gonna take a look at these. First one is Hims and Hers Health. It had a really great run back here from May until middle of June. And then it sold off and tried to make a comeback, but the MACD continues to fall. So that's a negative divergence. So it was showing that this was not a strong rally. It was a weak rally. It's below its peers. So underperforming its peers, underperforming its own moving average. The accumulation distribution line is down. It is sitting right on the 200-day moving average, which is a place where many times it might bounce. It is in the healthcare sector, healthcare providers, and the healthcare sector itself has actually been pretty strong. But the stock is not looking too good. So we'll see what happens, but it is absolutely in a downtrend. It's making lower highs. The MACD is below 0. It's underperforming its peers. This is not one that I would want to be in right now. If it does bounce, I probably would take the opportunity to get out if I was in it. But this is not meant to be a recommendation to buy or sell. I'm not a financial advisor, so I can't give you advice on what to do. This is purely for educational purposes. And by the way, these little buttons on the left over here, I have different ways of looking at the chart. This is my default view, which pretty much shows me everything in one view. But I can look at a 5-month chart with the typical candles right there. And you can see it's continuing to go down. The earnings was on August 5th, which was right here. Doesn't look like they had too much great to say for earnings. The next one here is this is kind of my go-to chart if I want to look at a close-in view. So this, again, below the 0 line, lower high. It's below all the moving averages. I just added this one. This is the IBD style. So this is the style that IBD uses for their charts. And I tried to duplicate it as closely as I possibly could. This down here, interestingly, is IBD has something called relative strength, but it's nothing more than comparing the stock with the S&P. So how is it doing versus the S&P? So they put rankings on it. I don't have a ranking here, but it does show you that it's underperforming the S&P and in the volume. But this looks almost identical to the IBD chart. So I just added that one. This is the 1-year daily chart. It was a 2-year, but now it's a 1-year, just so I get a better look going back to see where support and resistance is. This was a weekly chart. If I want to see the longer term, going back 3 years, still looks pretty good overall from a long-term basis. So we'll have to see if it can recover the strength that it had before. Relative strength shows how it's doing versus its peers, how it's doing versus the S&P, how the sector is doing versus the S&P. And you can see right here, the healthcare sector is actually doing pretty well. How its industry group is doing versus its sector, and it's actually outperforming. The industry group is outperforming its sector, but the stock is underperforming the industry group. So that's another red flag for HIMSS. And then finally at the bottom, how's the industry group doing versus the S&P is also outperforming, but HIMSS is not. So that's not a good look. This is a 10-minute chart, just in case you want to take a look at what's going on during the day and how the VIX looks. Actually, I'm going to look at the VIX too in a second. Here's a Keltner trend channel. So if it gets down here to 3x, that's an area where it won't stay very long. Even where it is right now, it's pretty overextended. So I would want to see it get back above that 5-day moving average right there. And this is reversion to the mean, the 21. You can see it came right up to it and then got rejected. Came down below it, above it, below it, above it, right through here, just going sideways right along that 21-day, and then finally broke through. This is a riding the wave, which is it's actually the squeeze from John Carter. So this is John Carter's squeeze. I've basically duplicated the way he sets up his squeeze. He actually has an indicator that gives you a much better view of what it does, but anytime it turns green right here, that means it's in a squeeze. Basically, it's going sideways. It's going to break out one way or the other. And then finally, the chandelier exit shows you both the exit for a bullish trade, which is the green line. So it was bullish all the way through this period. So the exit was right there. And then the red one is a exit for a short play, meaning if you were shorting when it was down here, then you wait for it to get above that red line to cover, to exit your short. So in this case, it's definitely in a short configuration. It was bullish back here, it's bearish through here. I like to see it above both of them, like it was back in this area right here, right through here when it first got up there. That's what I like to see. So that's how all of these little buttons are configured. And on the website for subscribers, on the chart lists and scans page, I have all of my favorite styles. And I put a date in here now because I don't always use the same ones. Sometimes they stay in there for quite a long time and maybe always will be there. But there are certain ones like the IBD style that I just added to it. And I took out one that I wasn't using very often. So as I use these over time, the ones that I don't seem to be using much, try to replace it with something that is a little more interesting, like the IBD view. So that's what those are. Those are right on the website. If you have a subscription stock charts, and this right here shows you all the subscriptions. I have scans built that you can copy and paste if you have a subscription. And these little buttons here, you can just pull them right into your own stock charts if you have a subscription for stock charts. So I just make it very easy to duplicate those. Last thing I mentioned was the VIX. So the VIX has now, in the last couple of days, spiked higher. So if we look down here, we'll look at two views of this. There's the VIX. This is the big spike in July, right at the end of July right there. But you can see right here, it's back above the 20. So above 20, bears are in control. And as of yesterday, the VIX closed above 20. It went higher and then pulled back a little bit, but still closed above 20. So what we like to see is it below 17. And down here is the moving average lines, the blue one starting to accelerate. The green here is the 12-month rate of change. So you can see that the rate of change is also accelerating. So if this continues to go higher, then the market will continue to sell off. And this was our warning sign back here. This is a correlation of the VIX versus the S&P. And anytime usually the VIX and the S&P run opposite to each other, but anytime they are correlated, that means we're probably about ready for a trend change. So, and that's what happened right back here in July. They correlated right here. The VIX started to move up and then finally went above 20 right there. So that was our early warning that was about to happen. The other way to look at the VIX on here is this VIX chart, which shows you a little better view of above 20. The gray area is the actual number for the VIX, and then the red and the green are the moving average lines. So when the faster one goes above the slower one, red goes above green, that means it's accelerating to the upside. And the actual number is above 20 right now. And you can see what happens when the VIX accelerates like that. Even back here, VIX started to accelerate, market sold off, it hit a high, a peak right there, started to come down, the market started to rally, and now we're selling off again. This is the 10-day moving average of the put call ratio. So down here, there were lots of puts right here in July. So that was giving you notice, and as those started to decline, started to give you notice that a rally was potentially coming. So those puts are starting to decline again, interestingly. So we'll have to see what happens. And then the 10-year Treasury yield, of course, continues to sell off. Way down here, it's just been going sideways for a while, but all of these things are on the same chart. So you can just get a sense for what the sentiment looks like in the market. So that's it for now. Keep an eye on that jobs number on Friday. I think the market tomorrow probably will sell off some more or just hang around and go sideways, waiting for that jobs number. Like every September, it typically sells off and doesn't start to rally until the middle of October. But we have some catalysts coming up that might buck that trend. I'm not saying that it will, but just interesting the catalysts we have coming up in the next 2 weeks. So keep an eye on that. So thanks a lot for listening. Give me any comments that you have down below. If there's any stock that, the other stock that that person asked me about, in addition to HIMS, was Annaly. I'll look at that real quick. Here's Annaly. Annaly is just going sideways. It's in the mortgage REITs group in real estate. Annaly Capital Management is going sideways, so it's not really doing much. Actually, let's look at that on the squeeze. So there's a great example. Anytime you see a stock go sideways, I can almost guarantee that it's going to have a squeeze like this. This is the kind of thing that John Carter looks for. If you see that bright green right there, that means it's in a squeeze. It's going sideways. It's squeezing even tighter. It's getting ready to have an explosive move one way or the other, but you don't know which way. It could be up, could be down. Hard to say. The IBD style, just out of curiosity, that's what it looks like. Hit a low way back here in November, and it's just been steadily climbing since then. I think when the Fed cuts in September, probably mortgage companies will start to do better. I suspect that they will. So that might actually be the catalyst for Annaly. This is a long-term weekly chart. And you can see it's just beginning to get above its 200 and all of its moving averages. So it's starting to move higher. And then this is what the moving averages look like. This is called stacked moving averages. So that's what you want. You want to see the fast ones on top and the slow ones, like the 200, which is this gray line on the bottom. And these are all the ones in between. So for a bullish configuration that they actually crossed right back around here, December of last year. And then they have been in a stacked configuration throughout most of this year, coming down, having a little correction and then going back up again. But these moving average are beautifully stacked right now. And you can again see the squeeze right there, squeezing pretty tightly. So this is one that might actually break out to the upside when the Fed cuts rates in September. All right, those are the two that somebody asked me about. So if anybody else, if you're interested, I'd be happy to take a look at any stocks you have if we have time. But that's it for today. Good luck trading, and watch that jobs number on Friday. Thanks, everyone.